In this video, I am going to share with you how Mapletree Pan Asia Commercial Trust Mpact stands to gain from potential interest rate cuts. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and I've been covering topics such as stocks, finance, CPF, and basically everything related to growing your wealth. The Investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've also covered over 500 videos and over 200,000 watch hours as of August 2024. I also occasionally focus on topics related to regional or world economy. Today we're diving into an exciting development in the Singapore Reit market. Mapletree Pan Asia Commercial Trust, or Mpact for short, is making waves in the financial world. Why? Well, it's all about interest rates and how they could give Mpact a serious boost. First, let's break down what Mpact is. Think of it as a big basket of prime commercial properties spread across key Asian cities. It's like owning a piece of the most sought-after real estate in places like Singapore, Hong Kong, and Japan, all wrapped up in one neat package. Now here's where things get interesting. DBS Group Research has pointed out that Mpact is in a unique position to benefit from potential interest rate cuts. It's like Mpact is sitting on a financial springboard, ready to jump higher when rates go down. But why is Mpact so special in this regard? It all comes down to two main factors: leverage and debt. Let's start with leverage. Mpact's gearing ratio, which is basically how much debt they're using compared to their assets, is at 40.3%. In the world of REITs, that's on the higher side. Think of it like a seesaw. The higher you are, the more dramatic the effect when things move. Now let's talk about debt. Mpact has a big chunk of debt, about $140 billion, coming due in the 2025 financial year. That's a lot of money to refinance. But here's the kicker. About 78% of their current debt is either hedged or on fixed rates. This means they're somewhat protected from wild swings in interest rates, but they're still exposed enough to benefit when rates drop. So, what does this all mean in real terms? DBS Research estimates that for every 25 basis points, that's 0.25%, that interest rates drop, Mpact's distribution per unit, DPU, could go up by 3% to 5%. To put that in perspective, if you owned 1,000 units of Mpact and were getting $100 in distributions, a 25 basis point drop in rates could bump that up to $103 or even $105. Now, you might be thinking, Iggy, that doesn't sound like much. But remember, we're talking about a potential series of rate cuts. If rates drop by 50 or 75 basis points, we could be looking at a much more significant increase in distributions. Let's put this into a real-world scenario. Imagine you're running a small business, and you've taken out a loan to expand. If the interest rates on your loan suddenly dropped, you'd have more money left over each month, right? That's essentially what's happening with Mpact, but on a much larger scale. This potential for increased distributions is why DBS is pretty bullish on Mpact. They've given it a buy rating and set a target price of $170. They're also projecting a pretty attractive dividend yield of 6.8% for the 2024 financial year. To put that in perspective, that's like getting $68 for every $1,000 you invest just in dividends. But let's take a step back and look at the bigger picture. Why are we even talking about interest rate cuts? Well, it's all part of the economic cycle. Central banks, like the US Federal Reserve or the Monetary Authority of Singapore, use interest rates as a tool to manage the economy. When they want to stimulate growth, they lower rates. When they want to cool things down and fight inflation, they raise rates. We've been in a period of rising rates for a while now, as central banks have been trying to combat inflation. But many economists believe we're nearing the end of this cycle. If inflation starts to come under control, we could see central banks start to cut rates to support economic growth. This is where Mpact's position becomes really interesting. Because of its high leverage and large upcoming debt refinancing, it's particularly sensitive to these potential rate changes. It's like Mpact has a financial amplifier. When rates go down, the positive effects get boosted. Now, it's important to note that investing always comes with risks. While Mpact looks well positioned to benefit from rate cuts, there's no guarantee that rates will actually go down, or that they'll go down as much as some people expect. Also, REITs can be affected by many other factors, like property market conditions, tenant demand, and broader economic trends. That's why it's always crucial to do your own research and consider your personal financial situation before making any investment decisions. Don't just take my word for it. Look into Impact's financial reports, read analyst opinions, and consider how it fits into your overall investment strategy. Remember, successful investing is not about chasing the hottest tip or trying to time the market perfectly. It's about understanding the fundamentals, diversifying your portfolio, and making informed decisions based on your financial goals and risk tolerance. In conclusion, Mpact presents an interesting opportunity in the current economic climate. Its high leverage and upcoming debt refinancing make it particularly sensitive to potential interest rate cuts, which could lead to increased distributions for unit holders. However, as with any investment, it's important to consider the risks and do your due diligence. If you guys enjoyed this video, then you're going to love this video where we review CNA Insider's documentary on Reit's. It's a great companion piece to today's discussion and will give you even more tools to make informed investment decisions. Check it out, and I'll see you in the next video.